Hello everyone, welcome to today's video around Netflix. I am your host Nikos Zabouras, Senior Market Specialist at FXCM. What we will be talking about is the upcoming earnings for the second quarter of the year, which are due in a few days on Wednesday, July 19th, after US markets close. They come in a transitional year for the streaming pioneer, since after a poor 2022, it had to make strategic business changes, which so far reflect well to the stock and to its subscribers and overall metrics. Just to timestamp this video, it is being recorded on Friday, July the 14th. Before we begin, please read carefully through the risk warnings and the disclaimers. Okay, let's get the ball rolling. Let's start with the backdrop, what we have seen so far this year. So, back in 2022, Netflix, the tech world in general, had to face an unfavorable external environment, and this persists into this year as well. This external environment was high inflation and high interest rates, which are not good for consumer nor for the tech companies. Consumers have less to spend, especially for such non-essential services such as streaming, while the tech sector is especially vulnerable to this high interest rates environment that we're seeing. So these were headwinds last year and have moved over into 23, but there are signs of improvement since inflation has been coming down and the Fed in the United States looks that it's moving towards the end of its tightening cycle. Of course, not just those external adversities. Netflix also has to face increased competition from legacy entertainment's heavyweights and tech giants alike, which have also been throwing their hearts into the direct-to-consumer arena. In terms of content, in my view, Netflix lags, especially against those legacy entertainment giants. Disney, for example, has the Marvel Cinematic Universe, has Star Wars. These are two of the biggest franchises of Hollywood. And of course, it also has ESPN that has sport. Warner Bros. Discovery, another legacy entertainment giant, has DC Comics. And despite their lackluster performance in terms of broad appeal, they're trying to reboot it. To reboot the DC universe. They also have Harry Potter, and of course, the perennial fan favorite and critically acclaimed HBO channel. And then we also have Paramount, which has the Tom Cruise universe, as I like to call. Now, there are, of course, tech heavyweights as well. Apple and Amazon both have entered the direct-to-consumer arena and have already produced content that is quite appealing to consumers, but also to the critics, having also clinched various nominations and awards. Now, Netflix is no longer the undisputed king of streaming. after the shocking loss of subscribers in the first half of 2022, Disney dethroned it. And let's actually go ahead and see that. You can see in the first quarter of 2022, Netflix was still ahead, but that changed in the following quarters. Disney moved ahead, and however, Netflix managed to regain the lead in Q1 of this year, but by a small margin. It had 232.5 million subscribers as of the end of Q1, while Disney had around a million less, and Disney actually lost subscriber in that quarter, as you can see on the right on the graph there. Just to mention that when we're talking about Disney direct-to-consumer services, we're talking about three channels: Disney, Hulu, and ESPN Plus, the sports channel. And we need to note that Disney reports in fiscal years, so that the calendar Q1 was actually Q2 for FY 2023. It is the 3 months ended April 1. So given these adversities and the collapse of its stock in H1, and we will talk a little bit more about the stock soon, the company was forced to rethink key aspects of its business and make strategic changes. The main ones are around password sharing and the introduction of an ad-supported tier, which I have long maintained is the future of streaming, the way forward for streaming, but we will delve that more into that in a few minutes. Let's talk about the stock price first. We can see the chart of Netflix here. The stock slumped in the first half of last year, but later stabilized and began to rebound. Markets have reacted positively to the aforementioned changes. Again, we will right after talk extensively about those. And the stock of Netflix has actually rallied around 50% in the first half of the current year, and around 170% since the May 2022 multi-year lows that you see here down on the left on the chart. Now, from a purely technical perspective, it has also formed a golden cross, which is often a precursor of sustained advance. However, there would be scope for a pullback given that the move looks a bit stretched. That's from the technicals, but that's not what we're focusing on today. And in my view, the technicals are in the background. What will matter for me most is what Netflix reports on Wednesday, and in general how its initiatives are progressing and how they are received from customers. So having said that, let's go ahead and talk what will be the focal points from that upcoming Q2 report, and start with those initiatives that we just talked about. Netflix had allowed its customers to share passwords freely for a long time, since that helped it actually grow in the early days, but is now posing revenue headwinds. So it has been trying for a while to monetize it, and it has been doing some testing in Latin America and elsewhere. These tests showed an initial cancel reaction, according to co-CEO Craig Peters. And let's go ahead and listen to what the CEO had to say back in the earnings call of the Q1 results in April.
So just to remind people what that looks like, very much like a price increase, we see an initial cancel reaction, and then we build out of that, both in terms of membership and revenue, as borrowers sign up for their own Netflix accounts and existing members purchase that extra member facility for folks that they want to share with.
Okay, that was Gregory Peters, co-CEO of Netflix, who spoke of an initial cancel reaction where this password crackdown was rolled out. Now, after an initial delay, the company made a broader crackdown on password sharing in June last month, which included US, UK, and other regions limiting access to one household. Given the comments we just heard, an initial churn may be hard to avoid because, again, Mr. Peters spoke of an initial cancel reaction. However, he said that then the company builds off of that in terms of revenue and memberships. Now, research from Antenna, interestingly enough, found that right as this crackdown in the US started, we're talking strictly for the US market, Netflix witnessed the fourth single largest days of user acquisition in the US. So there was actually people subscribing to Netflix. That was the fourth single largest days of user acquisitions in more than 4 years, according to Antenna's reasons. And that's since it started letting subscribers of the chains. Now, this is important because Netflix has to get this right. It does not have the luxury to turn customers away, given intense competition. So again, this is going to be crucial for its future. Now, the second major change is that the streaming pioneer launched in November a new low-priced subscription plan with the inclusion of advertisements. I've said this multiple times. This is the way forward for the direct-to-consumer markets, especially in this environment of saturation, high cost of living, heightened competition, and post-pandemic consumer behavior. What this plan can do is to lower the entry threshold in terms of price and thus potentially make Netflix more appealing. And more importantly, it can provide an additional revenue stream for the company that can allow it to look beyond strictly subscriber growth. So that's also crucial. So from what we've heard from the company so far is that it is pleased with the progress and has seen little switching from more expensive ad-free plans based on what it said on the Q1 report. However, more insights this time around will definitely be welcomed. I'm also looking to see any more thoughts around its intention. What I would consider perhaps a next step would be to maybe eliminate the lowest ad-free entry tier and start essentially with the one that includes advertisements. That could be a change, and maybe something that is not perhaps so much of an immediate need is whether it's going to offer a fast service at some point, a free ad-supported streaming television. It's like linear TV with free advertisements, so you don't get to pick and choose what you will see, but it's free and there is a specific feed, a specific programming there. Now, the number of subscribers, of course, will be, again, closely watched in order to gauge how consumers have reacted to those initiatives and to see if it has, if it's a chance to stay ahead of Disney, which of course reports later in this earnings season. The truth is that streaming is not a growth story anymore, and Disney has been losing subscribers recently. Netflix's user base increased by only 1.75 million members in the first quarter of the current year, and we talked about that earlier. And of course, it does not provide guidance anymore, but it will be, but it's still a very important metric, if not the most important anymore. Another thing that I'm interested in is, and it's a big question for me, is whether Netflix will enter into sports. As I said earlier, I believe that Netflix has a weaker content against many of its rivals, and many of them actually offer sports content. If it wants to stand up to competition, it will eventually have to tap that market. And this also looks like the next logical step after the ad-supported tier, since sports matches are naturally suited for inclusion of advertisements, given halftimes, timeouts, etc. However, this could be a tricky endeavor, technically, for one thing. And Netflix already has a lot on its plate with these strategic changes that we talked about. So, but it will be interesting to see if they have something more to offer there in terms of their intentions or any actual plans to offer such content or some type. Maybe it will be a standalone event, a sports event. And of course, the financials are always a focal point. However, unless there is some big surprise, these are less important in my mind, and they're mostly interesting to the extent that they reflect the impact of the strategic changes we have been talking about. Financials were solid in Q1, revenues in excess of 8 billion, with 3.7% year-over-year growth, although underwhelming for Netflix's standards. Net income was at around $1.3 billion, a bit lower than a year ago, but vastly improved compared to, on a sequential basis, compared to Q4 when the company had barely broken into profits. Now, the firm's forward guidance was a bit timid, I would say. Revenues projected to rise to 8.24 billion, but net income and operating margins will be a bit worse on a sequential and yearly comparison, again, based on the firm's own projections for the soon-to-be reported quarter. So overall, as I said, this is a transitional period for Netflix. Front and center are these initiatives around password sharing and the ad-supported tier. We haven't heard much about how they have been received from consumers and how they respond to them. So we will be definitely eager to hear more on that and how this reflects to user metrics and financials. Again, increased competition, so these are initiatives that the firm has to get this right. So that's pretty much it from me. Once again, the Q2 results for Netflix are out in a few days on Wednesday, July 19th, after US markets close, and we will be following them closely. Thank you for joining me.